asking any data to the assessee, without even coming at the assessee's premises through automation base itself, there is going to be a scrutiny that will be carried out. And it is being said that it is going to be highly precise and highly, I would say, specific review that would be carried out. So in the times to come, one thing is very, very clear, that non-compliance in indirect taxes, the cost of non-compliance is going to be extremely high in the form of automated system generated letters, notices being coming to the assessees. So it becomes extremely important for assessees to look at all the measures, all the systems that they can put in place to have preventive mechanism so that the dispute itself can be avoided. So today's topic is in the same backdrop. What we felt is that uh, most of you might have missed out on important judgments that have taken place or that have been delivered in the previous financial year, that is 22 and 23, by various authorities, be it tribunals, High Court, Supreme Court, on indirect tax matters, whether GST or service tax judgment having relevance on GST. So the idea of this session was to look at some important judgments, analyze them, and to see what is that the practical implication of that judgment is going to be on us, and what is that preventive action that we as a business would have to take to ensure that we don't fall on the other side of the law and don't end up litigating. Now, as we all know that in indirect tax more specifically, apart from regular change in law, it is also being seen that every other day there is some judgment coming in, and which becomes an important read. As early as yesterday, there was a very important landmark judgment in the context of online gaming, or the online, rummy, which has been there in the context of gamescraft. And the demand in that case was 21,000 crores, touted to be one of the biggest demands in indirect taxes. Of course, it is actually not the biggest one, but 21,000 crore tax demand is a very, very, very big number. And just yesterday, Karnataka High Court has given a favorable ruling quashing the notice which was issued by the department. In fact, our firm, we had the privilege of meeting the MD of the company of the same issue, wherein certain important aspects were highlighted to MD on what is that the preventive measure, if could have been taken, probably this notice would not have come, which has also resulted in our Bangalore team doing a very in-depth review of all the gaming transactions and the tax implications on this digital gaming transactions for Gamescraft. So what is that I'm trying to pass on a message is that while we would look at all these judgments, what is important is taking a learning out of these judgments and to see that how in our business, or how is that for our clients, we advise in a manner so that the litigation itself can be avoided in the first place. So with that intent in mind, we will commence or begin our session. The mechanism or the structure that we have looked at is, instead of, there may be 1,000 judgments that have come in the previous financial year. So instead of looking at or taking up 50, 60, 80 judgments and not giving justice to them, rather what we thought is that we will handpick some important judgments, dive deeper into them, understand the implications, and look at the takeaways from those judgments. So with me is Vyankatesh. Vyankatesh looks after the litigation division of our Pune branch. So Vyankatesh would be taking up these judgments, and I would be adding to it as and when it's needed. So Vyankatesh, over to you. You can commence with the deliberation and also present the presentation.
Thank you, sir, for the background. So with this background, we shall start the judgments. Can you move to first slide?
Yeah, it is visible, Vyankatesh. You can be a
Yeah.
bit louder and yeah, we can proceed.
So first judgment is in relation to secondment of employees by overseas company to the Indian company. So in this judgment, the Supreme Court has held that secondment of employee by the overseas company to the Indian company is falling under the services of manpower supplies, and accordingly service tax is to be payable. So if we go into the facts of this case, we can see that Northern Operating Systems is registered under service tax. They were registered under service tax under the manpower supplier category. During that regime, an audit was conducted by the service tax authorities. In that audit, the authorities verified various agreements entered by Northern Operating Systems with their group entities, which were registered in USA, UK, Singapore. And in that agreement, it was revealed that the Indian entity can request the group entity for various managerial and technical expertise services. And upon that request, the group entity shall send their skilled employees to assist the Indian entity. So when these employees are sent to the Indian entity, department is alleging that whatever services are being rendered by the group entity by way of secondment of this employee to the Indian entity shall be termed as import of services, and accordingly service tax should be payable. So the matter went up to the Supreme Court, and the biggest question before the Supreme Court was that who is the actual
Venkatesh, can you
employer?
be a bit louder? Bit louder. The voice is
Yeah.
little low, so a bit louder would be helping.
Is it audible now properly?
Yeah, audible now better. Yes.
Yeah. So the biggest question before the Honorable Supreme Court was who is the actual employer of this seconded employee? That is, if we treat that Indian entity is the employer, then what Indian entity is paying to the seconded employee is merely a reimbursement, and accordingly nothing was there to tax. But on the contrary, if we consider that foreign entity is the employer, then there are service element which is being provided by foreign entity to the Indian entity by way of secondment of employee, and accordingly there shall be service tax on import of services. So Supreme Court has analyzed this entire decision on the basis of doctrine of substance over form. What Supreme Court has analyzed that the overseas group entity is having a pool of expert employees which are seconded to various places. So these employees contribute in securing major contracts assignment because of their expert knowledge. And because of this expert knowledge, as they are able to generate additional funds by way of getting more contracts, there is a service element which is being provided by the group entity to the Indian entity. Now, one another aspect in this judgment is that the control over the seconded employees is with the Indian entity only. That is, for the period of secondment, the Indian entity will exercise full control over the seconded employees, but that control will only last till the date of secondment. That's after the secondment period is over, the seconded employees shall go back to their respective countries, and the control over those will cease to exist, and the salaries and entire thing will be processed by overseas entity only, and the Indian entity will only be giving the reimbursement. That is, whatever salary cost is being paid by the overseas entity will be reimbursed by the Indian entity. So Supreme Court had applied doctrine of substance over form and said that there is a consideration, there is something in return which is being given by Indian entity by way of reimbursement, and the overseas entity is providing the services of manpower supplies. So what the Indian entity is deriving out of this is that they are deriving economic benefit by obtaining specific job and by obtaining specific assignments, which result into additional revenue due to the secondment scheme. So accordingly, the court has held that there shall be service tax levy on the entire secondment issue. Now, this judgment is in relation to service tax regime, but if we see the implication under GST, we can see that there is an entry under Schedule 3, which says that whatever services are being provided by employee to the employer in the course of employment shall be outside the purview of GST. That is, it will neither be supply of goods nor supply of services. But if we take the cognizance of from this judgment, we can see that the outside entity registered outside India can be considered as employer, and the seconded employee transferred to the Indian entity can be termed as import of service, and thereby there can be a levy of there can be levy of IGST considering the import of service transaction. So what we have to do in this thing is that we have to check all the agreements which are there for the purpose of secondment of employee. We have to see that because of this secondment, whether there is anything additional benefit which the Indian entity is deriving, that why the employees are being seconded to India, what is the exact purpose of their secondment, and if that contract is giving out that the seconded employees is giving certain additional benefit to the Indian entity by way of doing some assistance in business, by way of doing deriving certain economic benefits to the Indian entity, then that entire contract can be termed as contract for service, which is rendered by overseas entity to the Indian entity, and it cannot be termed as contract for employment. So the biggest takeaway in this is that we have to go back and check all the secondment related transactions and see if there is any GST implication on the same. So after this judgment, what DGI has started, DGI has started issuing letters to various MNC companies who are registered in India and having their head offices outside India to see whether there is any scope for secondment of employment, and started issuing letters for that. And if we take the clue from this judgment, we can see that if everything is there, like if something is getting derived by an Indian entity, then there can be implication of import of services. Sir, anything which you want to add on this?
Yes. So this judgment has brought out a very, very important aspect. This was one of the judgments which everybody thought anyway, this will be in favor of SSC. Everybody thought that this judgment will come in favor of SSC because there is a relationship of employment when the foreign expat is coming to India and delivering and providing the service to the Indian entity. He is an employee of the Indian company, and hence it should not be liable to service tax under reverse charge. Same provision is also there in GST. So the fact that it should not be liable to GST under RCM was, I would say, a position that was being taken by many entities. More specifically, there are a lot of service sector and manufacturing companies, MNCs, where this is a very, very common phenomenon. Now, what we need to understand or make a takeaway out of this particular judgment is whether this judgment is applicable for all the transactions where there is a secondment, or whether it is applicable only to this particular judgment. Now, one of the very big learning, I would say, out of this judgment is that SSC has taken a lot of legal arguments. SSC has quoted multiple High Court judgments, multiple tribunal judgments, legal interpretations, analysis, and legal maxims. But what department has very rightly done, and why department has won this judgment, is because they went with the facts. They studied the agreements very closely. They understood the transaction much better than what Assassi himself was knowing. If you see this entire judgment, the entire case went in the favor of department only on the basis of facts of the particular case, without going into any other High Court, Supreme Court judgments or any hi-fi legal maxims. So now when we look at this judgment, it has come in the favor of Assassi because in the terms of the agreement, it was very categorically coming out that it is a temporary loaned staff, temporary arrangement, deputation, loaning of the staff. There was a global repatriation policy which mentioned that this is an assignment of the staff. The social security benefits which the erstwhile employee was getting, he was continuing to get that. He was rather continuing to enjoy all the employment benefits in the foreign company. These were all skilled manpowers deployed for a specific purpose, and this is precisely what the holding company does for rest of their group. So there were certain clauses where even the duration was mentioned. Now, in an employment agreement, nobody expects a duration to be there. Typically, that this particular person is going to be there employed for 6 months. Generally, employment agreements are perpetual unless either of the party decides to terminate the agreement. So when we looked at the clauses of the agreement, it was more in the nature of a manpower supply rather than a hardcore employment agreement, and that is why the matter went against the assessee. Now, with this, what is the learning that we need to take? If we are deciding not to pay GST on this particular transaction, then it's very important to relook at the terms of the agreement. More specifically, the secondment agreement, the employment agreement. How are the social security benefits being given in the foreign land and also in the Indian as per the Indian laws? We need to look at there are multiple ways in which the secondment agreement take place. There is a scenario where assessee gets the expat gets the full salary outside India and only per diem is being given in India. Or there will be a scenario where the full salary comes in India and nothing is there outside India except for the social security benefits. And there will be a hybrid structure where the expat gets salary in India and there's a partial salary also given outside India to take care of the expenses incurred by the family members. So we need to decide the taxability based on facts of each case, and this judgment cannot be a blanket application that there is an applicability of GST on all the secondment contracts. If an assessee is deciding to take a conservative view to any which ways pay GST and claim credit, then let me tell you that can also be a problem if it helps not to be liable to tax based on the facts of that case. More specifically, if assessee is in exempt supply, exempt business, or in the business of exports or refunds, then it can lead to either cost of taxes or blockage of funds. So in my opinion, assessee needs to look at the specific facts of the case and basis that decide the taxability in secondment contracts. So there is one question, I think we can immediately take that question. If we pay RCM for secondment employed today, will credit be available for services provided in financial year 17-18 and earlier? This is a very interesting question because now what has happened, department has started investigating into the matter of facts and they're asking RCM for all the past financial years as well. So in my opinion, first of all, whether to pay RCM or not cannot be taken, the view cannot be taken basis this judgment. It has to be analyzed based on the facts of that particular case. Assuming that it is liable for RCM, then in our opinion, the input tax credit should be eligible because the time limit in case of reverse charge would start from the time when the challan is deposited for payment of the tax. So credit should be available. There is another question which says some employee working in India and on the role of Indian company, but working for entity in abroad where Indian entity cross charge to its parent foreign company, whether we are liable to pay IGST on it. And on the role of Indian company, but working for entity in abroad. Where Indian entity cross charge. So in this particular case, there is a team in India sitting and working for the party outside India, whether it's liable for cross charge. See, again, this particular thing has to be seen based on facts. For example, if it is a simple accounting service or engineering service, it would not be liable for GST. Place of supply is outside India. But if it is something to do with intermediary transaction or let's say sales promotion, marketing based transaction, coordinating with the vendor, sourcing based transactions, where there is a nexus with the Indian counterpart, there could be a liability of GST on this, even though the billing is to a party outside India. So yeah, so Venkatesh, we can continue with the next judgment.
The next judgment is in relation to GST on ocean freight. In this judgment, the Honorable Supreme Court has upheld the Gujarat High Court judgment and held that there cannot be a levy of ocean freight on the there cannot be levy of ocean freight on transactions done on cost CIF basis. In this case, when we look at any CIF transaction, whatever there is arrangement between the parties, if the arrangement is on CIF basis, then the entire cost, insurance, and freight is being paid by the Indian importer directly to the foreign party. Foreign party shall engage the services of a foreign transporter who shall send the goods from the foreign entity to the Indian port. Now the charges for this is being charged to the foreign party only, and the Indian importer pays full value to the foreign exporter. Now, when these goods land to India, the basic custom duty and IGST is paid on entire CIF transaction. That is the cost, insurance, and freight element is again liable to be paid for BCD and IGST. On the other hand, when this entire transaction is getting taxed for BCD and IGST, there is another reverse charge notification which says that the freight transportation, which is the ocean freight transportation, is liable for reverse charge mechanism also. So whatever freight is being incurred by the foreign entity is liable to be paid under reverse charge. So in this judgment, the Honorable Supreme Court has held that the CIF transaction, CIF contracts are in the nature of composite supply. That is, the main supply is that of supply of goods. So cost, insurance, freight, though there are three elements, but the principal supply is that of goods only, supply of goods only. And Section 8 of CGST Act contemplates that tax liability on a composite supply would be only on the principal supply. That is, the entire transaction will get the color of principal supply only, and the entire transaction will be charged at the rate which is liable for the principal supply. So once the transaction is being charged as principal supply, then again demanding the same tax via reverse charge mechanism is not correct. And again demanding the same tax on which BCD and IGST is paid is also not correct. Since the Indian importer is liable to pay IGST on composite supply comprising supply of goods and services, in a CIF contract, a separate levy on the Indian importer for the supply of service by the shipping line would violate the Section 8 of CGST Act. Now, if we see the implication of the ocean freight transaction under current scenario, we can see that there can be three categories of taxpayers. One taxpayers who had availed services of ocean freight but did not pay any IGST on such ocean freight. Then it can be suggested that the decision of the Honorable Court is binding on all the assessees, and therefore those importers do not have to pay any IGST on such ocean freight. And also there shall not be any GST levy also. And taxpayers, then the second category of taxpayers who has paid IGST and claimed ITC. Then for those assessees who have already paid the tax and taken the ITC, they can maintain the status quo for the past and need not alter any position. So once the tax has been paid in the past and ITC is availed, the situation has become revenue neutral. So accordingly, there shall not be any position which has to be altered. And the third kind of assessees who has paid the ITC but could not, who has paid the IGST under RCM but could not avail the ITC. Basically, this situation arises where there is excess balance in the electronic credit ledger, or the services or goods provided by that taxpayer are under exempt category, and because of that purpose, they could not avail the input tax credit corresponding to that ocean freight IGST paid. So for those taxpayers, they can look at the possibility of availing the refund of that IGST paid under reverse charge mechanism. That refund application has to be taken properly by looking at the time limits given under section 54, and the major test which has to be satisfied while applying for this refund is the unjust enrichment. That is, whatever taxes which you have paid shall not be offloaded, shall not be passed on to some other person, to the buyer of the entire arrangement, and you must be the party who has borne the entire incidence so that you can claim the refund of those taxes. So anything you want to add?
The only thing is now it is settled. Supreme Court has mentioned that GST is not applicable on ocean freight. Let me tell you, this is explicitly in the case of CIF contracts. where the freight element is already included in the price of the goods that are being imported. Now, once this decision is there, there is no more requirement to pay GST and the reverse charge for the ocean freight. What is really important is if you have already paid in the past, let's say for financial year 17, 18, 18, 19, 19, 20 or 2021, then you can actually apply a claim for refund and claim the entire money as refund. This becomes important where you could not take the credit either because your certain supplies were exempt or you are into export transactions and the refund was denied on this, or the amount of ITC is still blocked lying in the electronic credit ledger. There are already numerous judgments that have come allowing the refund, and there are also judgments stating that the time limit of 2 years would not apply in this case because this was not at all liable in first place. Even otherwise, if it is argued that time limit is there to apply for refund, that is 2 years, again there is a order of Supreme Court and the department circular that this time limit of 2 years of during the COVID would be excluded for the purpose of calculating refund. So effectively, an SSE can go back 4 years and not 2 years for making a refund claim. So this becomes an important aspect here. Continue, Venkatesh.
Yes, sir. So the third judgment is in relation to intermediary services. In this judgment, the petitioner was registered under GST and was engaged in providing marketing and promotion services to their customers registered outside India. Petitioner used to solicit clients, used to solicit purchase orders, and the foreign client of the petitioner used to send the goods to their Indian customers. The petitioner used to earn commission income in this entire arrangement and used to pay taxes on the same. The commission which was received under convertible foreign currency. So the petitioner had argued in this case that since they are receiving foreign currency from the place outside India, the entire arrangement shall be termed as exports because the recipient of their services is also sitting outside India. What department has contended in this is that the arrangement which is being conducted by the petitioner is that of intermediary. And in case of intermediary services, the place of supply is to be looked at from section 13 of IGST Act. Now, the section 13 of IGST Act tells that in case of intermediary services, the place of supply shall be the location of the supplier only. So the supplier in this case is located in India, and the place of supply is also the same. Thereby, they have asked the petitioner to pay CGST and SGST on this entire commission income. So agreed by entire this arrangement, petitioner filed a writ petition with the Bombay High Court and told that the GST is a destination-based consumption tax. Thereby, wherever the services are getting consumed, wherever the goods are getting consumed, should be the place of supply. And rather than in case of these intermediate transactions, the law is asking that the place of origin shall be the place of supply, whereby it is creating a contradiction between what is the intention of the GST and what is actual there in the law. So what Honorable Bombay High Court has held that Section 13(8), which provides the place of supply in case of intermediary, has to be looked only within the four corners of IGST Act. Section 13(8) is legal, valid, constitutional only if it's read with IGST Act, and there shall not be any levy of CGST and SGST Act. If it's read with the IGST Act, then Section 13(8) is correct because 13(8) will apply only when either supplier or recipient is outside India, and therefore there cannot be any operation of CGST and SGST Act while reading Section 13 subsection 8. And second thing, while charging intermediary services, while charging the commission for intermediary services, there cannot be levy of CGST and IGST. There can only be levy of IGST in these transactions. So the takeaway in this thing is that the government should reconsider whether the whatever CGST and SGST has already been paid by the intermediaries in the past period, whether there is any need to rectify the same. Can department ask IGST element in that particular transaction? And second thing, once IGST is being levied on this particular transaction, then is there any possibility of making this entire arrangement as zero rated supplies? Because earlier, as there was CGST and SGST being charged, it was not a zero rated supplier. But now, as court has asked to charge IGST, then can there be a possibility of treating the entire arrangement as zero rated supplier? And third thing, if we look at the entire arrangement of the intermediary, the commission agent is sitting in India and it's facilitating the supplies between suppliers and the recipients. So though intermediary person is receiving commission in foreign exchange only, but it cannot classify the entire arrangement as zero rated supplies. So the basic idea of entire this arrangement is that when the services are getting consumed outside India, when the services are being rendered outside India, then the zero rating benefit should be allowed. And just because one clause is there in the entire place of supply provision, that in case of intermediary, the place of supply shall be location of supplier, that single clause is barring the SSC to claim the benefit of zero rating. So this is the judgment in relation to intermediary transaction.
Some points, or rather, I would say this judgment can have some larger implications. So precisely what Vyankatesh has mentioned is that intermediary transactions where there is a commission agent or broker in India and he is executing a transaction, he is intermediating or facilitating a transaction between a Indian party and a foreign party. And for whatever commission or the brokerage that is being charged by the intermediary is liable to GST. As per the place of supply provisions. Now, the court says earlier there was a Bombay High Court split judgment where one judge mentioned that it is unconstitutional to levy tax on a transaction where the there cannot be a place of supply in India, and Indian GST law does not have constitutional power to levy tax on this transaction. While the other judge countered this view and on the other having a contrary view. Now the third judge in the Bombay High Court in this case mentioned that both are right. In a way, he mentioned that yes, constitutionally it is incorrect that there cannot be a CGST and SGST on intermediary transaction, but there can very well be a liability to IGST. Now let me tell you. When the GST law came, this was very big issue because CGST and SGST is applicable where the location of supplier and the place of supply are in the same state. Whereas IGST is applicable where the location of supplier and the place of supply are in two different states. In this case, the location of supplier and the place of supply both are in the same state, and that is why many businesses have went ahead and charged CGST and SGST on this transaction. Now, in this judgment, department says that there cannot be a levy because the CGST Act does not have the authority in the first place to charge tax on the export transactions, and it can, even if there is tax liability, it is only IGST and not CGST and SGST. Now, fundamentally, if someone has already paid CGST and SGST, will department again raise a demand based on this judgment to pay IGST? Is an important question to deliberate. Someone may ask, what is the difference? Anyway, SSC has paid the tax, so why department should again demand? There is an issue because in CGST and SGST, there is a SGST portion which has gone to the state government. Whereas in case of IGST, in this particular scenario, there may not be any revenue to the state government. Reason being, whenever we are disclosing IGST in the GSTR1, we also disclose the place of supply. And if place of supply is, let's say, Haryana, Gujarat, or Bihar, the 50% of the IGST goes to the respective state. But in this transaction, the place of supply would rather be disclosed as other territory, as serial number 97, other territory. Now, if the place of supply is given as other territory and you don't tag any respective state, then there is no mechanism in the law. There is no system, or I would say procedure given to distribute this revenue to the state government. In a way, central government would tomorrow argue that in this case, state does not have even authority to levy or collect tax, and hence the entire 100 rupees or that 18 rupees tax has to be with the central government only and not the state government. So if your jurisdiction or administration is with the central government, then you should be prepared that there could be a possible demand coming from the central government for the balance portion. Now, the question that comes is, if assessee has already paid CGST, SGST, whether he again needs to pay IGST? Answer is yes, and claim refund from the state government for the CGST and SGST portion. Whether the demand can be only for the 50% portion of the state? No. The demand will be full for 18%, and again he has to claim back the 18% refund. Absolutely harsh implications if it goes through this way. Another important aspect to be looked at, instead of going through this entire mechanism of paying and claiming refund, can one look at directly adjusting it off in the GST returns, relying on circular number 26 of 2017? I would say this is possibly, yes, it is possible, as long as whatever the revenue implication that has taken place between the treasuries is taken care of. But whether this would be disputed by the department, yes, department would dispute this particular adjustment or settling of the taxes. Very important to note that in case of intermediary transactions, where let's say there is a person in India providing the support to outside India, there is not always a commission element. There is an administration support. There is a marketing support. There is a sourcing support. So multiple supports are being given by this person. So if a business is taking a cost of taxes on account of intermediary, because a foreign company is not going to pay you GST, let me be very clear. In that case, assessee must look at structuring their agreement that to the extent of administrative support, marketing support, technological support, supply chain support, can there be a separate pricing mechanism in the agreement so that there is no GST liability, and to the extent of the facilitation and the commission, they can pay GST. So this is extremely important. This was already held in the erstwhile regime in the judgment of GoDaddy, and also I think that was an advanced ruling, and also in the case of Microsoft. So this is something a businesses must look at, restructuring the agreements in case of intermediary. Second very important thing is there is a circular. This issue is also being faced by a lot of BPOs and outsourcing companies in the technological IT sector, where especially State Department is treating it as intermediary and not giving the refund. There is already a circular issued by department saying that these are not in the case of intermediary. So these are, I would say, few implications that arise out of this judgment that needs to be taken care. There is one question: from which date will this judgment on intermediate transaction apply? There is no specific date. Once this judgment is there, it would apply from retrospectively, because judgment is not the law. Judgment is only the analysis of the law already existing. So it would have implications right from July 2017. Yeah, we can proceed, Vyankatesh.
So the next judgment is in relation to pre-import conditions, which are attached to the advance authorization scheme. So prior to introduction of GST, advance authorization scheme provided exemption from various duties such as basic custom duty, surcharge, cess, CVD, SCD, etc. Against the imports, the exemption was there. The only condition was that the inputs which are been imported shall be used in the manufacturing of the export products out of India. So the prevailing practice at that time was that exports was being made prior to the imports were also permissible in that scheme. That is, the person can make exports and at the same time they can also import the goods. So the goods which are being imported can just replenish the existing stock. That is, there was no one-to-one mechanism which was needed to be proved that the goods were first to be imported, then only the manufacturing will take place, and then the export will take place. Like that, there was no arrangement, and the person can make exports, and at the same time, he can keep on importing the duty-free goods. So this was the arrangement before the introduction of GST. And after introduction of GST, all the duties such like CVD and SAD was subsumed under IGST. But the exemption which was provided to CVD and SAD was not provided to IGST in the initial days. Thereby, the importers had to pay the IGST element, even if they are advance authorization operators, they had to pay the IGST element and import the goods. Then, after receiving various representations from the trade and industry, government on 13th October 2017 restored the exemptions to IGST. But that exemption came with a cost. That exemption came with a condition of pre-import. Now, the term pre-import has never been defined by the government, but what DRI officers and the custom officers have stated that pre-import condition is a condition whereby the goods have to be imported first, and then the product manufactured from such imported goods shall be exported. So the said IGST exemption, which was applied from 30th October, was subject to pre-import condition. And as the advanced authorization operators were so much used to the older scheme that they continued the old practice by making exports using old stock only and thereafter importing the duty-free goods so that their export will not get stuck up, but the continuous process will go on. Now, after some time, that is in 10th January 2019, the government of India omitted the pre-import condition. So the omission is still a vague omission because they did not clarify whether this amendment is retrospective or prospective. So it has retained the ambiguity of pre-import condition during 13th October 2017. That is when they brought the IGST exemption till 10th January 2019. That is the date on which they omitted the pre-import condition. So what these DRI officers did, DRI officers issued notices for this brief period of 15 months, whereby they are asking advance authorization license holders to pay the IGST amount because they did not do so and they could not prove that the imported items under advance authorization scheme have been used for making the exported products. So various writ petitions were filed, and one of the writ petition was in the case of Vedanta Steel by Madras High Court, in which the Madras High Court has rejected the petition and said that yes, pre-import conditions has to be verified in that particular period. And one of the judgment was rendered by Honorable Gujarat High Court, which struck down the pre-import conditions, stating that pre-import conditions are arbitrary and against the basic concept of exports. So revenue had approached to the Supreme Court against this judgment of Gujarat High Court. Now the Supreme Court has held that pre-import conditions are valid. The validity of the pre-import condition cannot be determined just because it is causing hardship and inconvenience to the importers. Yes, the importers were enjoying the status of not showing the correlation, one-to-one correlation between inputs and outputs. But after imposition of this pre-import condition, just because it is creating hardship and inconvenience, it cannot be the sole reason to strike down entire pre-import conditions. First point. Second point is that this DGFT is having authority to impose the pre-import conditions. It was there earlier also, but for some other goods. So they did have that power. And third thing, that right to claim the exemption of IGST is not a unconditional exemption. It cannot be universally applied. It has to be there with certain conditions, and those conditions have to be strictly followed. So with this background, if we look at the impact of the judgment, we can see that government here needs to intervene and state what will be the fate of those 15 months from where they have given the IGST exemption to the date when they struck down the pre-import condition. What will be the fate of that? First thing. Second thing, if the advance authorization holders take cognizance of this judgment and pays the IGST for that period, so how that payment will be, like if they pay through TR6 challan, then there again will question of input taken from the basis of that TR6 challan. because as per Rule 36 of CGST rules, TR6 challan is not one of the documents through which you can claim the credit. It's the bill of entry through which you can claim the credit. So the third option which is available to the importer is that they have to first amend their bill of entries to incorporate the IGST element, and on that basis of corrected bill of entries, they have to take the IGST credit. So this is the judgment in which the government has to clarify that what shall be the position, and accordingly the importers can take a call. Sir, anything you want to add?
Nothing much in this. We can proceed.
Okay, sir. The next judgment is in relation to GST on 1/3 land deduction. A brief background of this case. In this case, the applicant had entered into an agreement for purchase of land and construction of bungalow on that particular land. A separate consideration was charged and agreed upon by the parties. The consideration specifically specified this land portion and its consideration and the construction of bungalow on that particular land. So the applicant believed that purchase of land is outside the purview of GST, and accordingly he is only liable to pay taxes on the construction services which will be done by the builder on that particular land. So land anyway is not under the GST. So only thing which we can on which he has to pay the taxes is on construction services portion only. So the seller of that particular construction services insisted on payment of GST on entire consideration, that is land also and construction services also, after providing 1/3 deduction of the value. Like whatever is the consideration minus 1/3 deduction, which is in accordance with notification 11/17, shall be the valuation according to the GST law. So agreed by this entire arrangement, the applicant filed a writ before the Honorable Gujarat High Court to strike down that particular notification serial number, which states that the land deduction is only 1/3 of entire value. So in this case, the Honorable Gujarat High Court has struck down the 1/3 land deduction. It says that the 1/3 land deduction, it provides that fixed set of deduction of 1/3 of total consideration towards the value of land is ultra vires, and the provisions of the scheme of GST Act. It's against the basic principle of GST, and therefore a uniform rate cannot be applied to the entire consideration across all the transactions. Second, the mandatory deduction of 1/3 for value of land is not sustainable in cases where the value of land is easily ascertainable, or if the value of construction services are easily ascertainable. So if value of land or construction services are easily ascertainable, then there is no requirement to take mandatory 1/3 deduction. You can easily compute the value of land. And third thing, the deeming fiction created by treating the land only 1/3 is not correct in nature, because the value of land can vary from city to city, place to place, situation to situation. So therefore, applying a blanket reduction of 1/3 is not correct, and the court directed the GST authority to refund the excess amount, which is balanced between 1/3 and the actual land value. So the major takeaways which can be there from these judgments is that can this judgment be applied in the case, in our case? First thing. Second, who can claim the refund if there is a difference between the actual value of land or the 1/3 land deduction? And third thing, can this judgment be applied in the prior period? So one thing in this judgment is that if the entire incidence of duty has been borne by the purchaser of the flat or property, then the builder cannot claim the exemption. The buyer has to claim the exemption first. Second, if you look that whether this 1/3 land deduction is optional or what, we can always see what's more beneficial to the taxpayer. If the actual land value is more beneficial, then the buyer can proceed with the actual value, ignoring the 1/3 land deduction. But yes, since this is the High Court judgment and it is pending before the Honorable Supreme Court, the applicability of the judgment is always questionable at this moment. Sir, anything you want to add?
Yes. So now we have two judgments with us on this particular issue. One is Gujarat High Court, and very recently even Madras High Court. Now this is extremely clear that GST law has no business in giving the valuation, that to a deemed valuation, about a transaction which is not at all covered under GST law. So when the land is outside the purview of GST, there cannot be a valuation mechanism decided under GST law. One, assume for the time being that even if it can be decided, from where this concept of one third has come? I mean, why government has decided only one third? What is that? Why not one half? And why not two third? Why not 80%, 90%? Because it totally depends on the nature of construction and where the construction is happening and the quality of transaction type of construction that is taking place. If the construction is in Mumbai or any metro city, any posh area of a metro city, the land value can actually go to 90%, 80 to 90%. So then giving a deduction of one third is absolutely unjustified. Second, in a case of a villa project, generally the value of the land would be substantially higher as compared to an apartment project. Similarly, in case of a transaction where the project is being taken over in the middle of a construction, there will be significant spend towards the land, and there'll be hardly any spend towards the other than land portion. So even in those cases and all these typical scenarios, giving the deduction only of one third is absolutely unjustified. This is point number one. Point number two is that this has been brought by way of notification, whereas the law provides a mechanism that the valuation has to be as per valuation rules. Without bringing it as a part of valuation rule, this has been brought as a notification itself is held to be incorrect in Gujarat High Court. Very important aspect is that this calculation which has been made of one third, there is a judgment of Wipro Limited Supreme Court in the context of customs, which mentioned that if you are giving the dimming value, if you are telling one third, there is no problem. You can tell one third, you can tell one half, whatever. But give assessee an opportunity that in their case, if the value is more than one third, then if assessee is able to produce the actuals, then you should give the benefit of actuals and you cannot say it should be only the standard deduction. So the judgment is very valid, very legal judgment, because it says that you give one third, but you give the right to give actuals. In my view, this judgment would definitely stand even in Supreme Court. What is important is that many builders are taking the cost of GST even today. They are collecting 5% from the customer, but paying 12% to the government, taking the cost of 7%. It is important that the builder today itself make an application for refund by doing an actual calculation. If a builder is not making an application for refund today and waiting for Supreme Court to give a judgment, then we find very difficult that they would be able to get the refund, because by then the time limit of 2 years would be completed. So in all the builder cases, they have to calculate what is the impact if the land value is calculated on actual basis, and if the impact is significant, then they must file an application for refund immediately. So we can proceed with the next judgment, Venkatesh.
Yes, sir. So the next judgment is in relation to eligibility of ITC if the taxes are not paid to government. So we all know that whenever we procure any goods or services, there is a condition which is needed to be fulfilled under section 16. So one of the condition is that the taxes in relation to such procurement has to be paid to the government. So in this case, the petitioner had received notice from department stating that the input tax credit which they had availed are on the basis of supplies where the suppliers have not paid GST to the government. So we all know that the GSTR 3B is just a time gap arrangement by which the suppliers will provide their output supply details and input supply details, and the balance will either with the balance will be either carried forward with the next return or they have to make the payment. So there is no one-to-one mechanism through which you will be able to understand whether that particular supplier has paid the GST in relation to the procurements made by the taxpayer. So in this case also, petitioner had contended that he has fulfilled all the conditions which is given in section 16, and he has also made payment with the he has also made payment to the suppliers, and the supplier is supposed to pay with the government. Petitioner also relied upon the High Court's various High Court decision stating that ITC cannot be denied just because of there is a fault of supplier. Once I have proved that entire procurement has been done in a bona fide belief and all the documents are present, then such ITC cannot be denied, was the contention of the petitioner. So interestingly, in this judgment, the Honorable Court has held that Section 16, which provides the condition for taking the ITC, has to be read strictly, and there cannot be any jeopardy to the interest of the revenue. That the interest of the revenue cannot be affected in any situation because the GST law has been enacted after the experience of various laws. So the condition that the tax has to be paid with the government is an absolute condition, it has to be met. So the court observed that GST law has ensured that in such cases, the tax liability has either been made by supplier or the recipient. Though the substantial liability is on the supplier only, but a protective liability can also be placed upon the purchaser. So in these cases, in case the tax liability has been made by the recipient of the supplier by way of reversal of ITC, and later on in a future date, if department is able to recover the same amount by the supplier as well, then it would amount to double benefit to the revenue. That is, if a transaction is say of 100 rupees and tax charge is say 18 rupees, once you ask the recipient to reverse the 18 rupees and then asking again to the supplier to have that 18 rupees will amount to double benefit to the revenue, and therefore the court has suggested to put up in a place a situation, a mechanism through which once the recovery is made from the supplier, whatever recovery was made from the recipient can again be paid back to the recipient, and recipient can enjoy that ITC. So if we look at the impact of this entire case law, we can see that the court has suggested first to put a mechanism in place, and second, one important observation, which is that the primary responsibility is always on supplier to make the payment to the government. And if this in rare cases where the supplier is not traceable or where there is any serious offense against the supplier, then only the department can ask the recipient to pay the taxes. So anything, sir, which you want to add here?
The only thing is, this is, I would say, very important judgment. This was also viral on various WhatsApp groups and social media. The point is, department is taking a view, the courts are taking a view that if department has not got the money, how can they give an input tax credit? This is precisely, I would say, the J1, J2 concept which was upheld in the Maharashtra VAT laws. So the point is, assessee must be conservant of this particular fact that this kind of issues can come in future while assessee is claiming ITC. And hence, it is important that the assessee, at this point itself, safeguard its ITC by either deducting from the supplier's bill or by taking a conservative stand of not claiming the ITC. Very important remark which the court has made in this judgment, when the assessee has quoted some judgments of the past laws, especially service tax law and the Delhi VAT. Department has told the court has told in this judgment that this is a learning that the department has taken from the past laws which were not proper. So the point which I'm trying to make is, maybe for financial year 17, 18, 18, 19, 19, 20, and 2021, up to financial year 2021, assessee can have a very good cushion because there was anomaly in the law and there was anomaly with the technological framework that was put in. But afterwards, the law also seems a little stringent and taking any credit based on books of accounts, and where the assessee has not paid the taxes to the supplier has not paid the taxes to the government is going to be little tricky. Having said that, the court has also mentioned that department has to put a system of where there is no double collection of taxes. Even today, there is no system in place to check that there is no double collection of taxes. Precisely speaking, department is making a double collection of taxes today, and there is still the technological framework is not in place. So that is one argument which is still in favor of assessee that can be taken in future. But having said that, we would always recommend, to go for a conservative approach and better deduct the money right now rather than, disputing it unnecessarily. Yes, Venkatesh.
Yes, sir. So the next judgment is in relation to the alternate remedy. So in this case, petitioner had received one show cause notice in which the hearing date was not mentioned. Hearing date was blank. So petitioner was not able to attend to the personal hearing because of unavailability of the date, and accordingly, ex parte order was passed. So petitioner has filed a writ petition with the honorable court in which it has stated that the opportunity of personal hearing is mandatory under the law first, and second, since this opportunity is mandatory, non-granting of the same is violation of principle of natural justice. The revenue had also contended that since the order has been passed, the petitioner is having a proper remedy, an effective remedy of appeal. Then once there is an effective remedy of appeal, then there is no need for applying to the High Court for the protection of the petitioner. So in this case, interestingly, the court has held that Section 75, subsection 4 provides compulsory grant of personal hearing in cases where there is a request for personal hearing, and second, whenever there is any adverse order against the assessee. So in these cases, the provision of personal hearing cannot be skipped and personal hearing has to be granted. First thing. And second thing, just because the assessee is having alternate remedy, which is the assessee is having a equally effective mechanism to go against that order, that is by filing the appeal, it does not bar the High Court to intervene in this kind of cases because it has discretion in exceptional circumstances. That is, in certain circumstances, even there is a presence of alternate remedy, the High Courts can exercise its jurisdiction and grant relief to the petitioners. And which of these circumstances whereby the High Court will ignore the alternate remedies are first, lack of jurisdiction. Second, challenge to ultra vires provision. That is, whether any provision in the law is ultra vires to the parent act of the Constitution, the High Court can intervene. Third, violation of natural justice. Like we have seen in this case, non-granting of personal hearing is violation of principles of natural justice. So in this cases also, court can ignore the alternate remedy and grant the relief. For infringement of fundamental rights, any fundamental rights granted by the Constitution, if the non-violation of the same can uh, can provide power to High Court to exercise jurisdiction. Next, non-following a prescribed procedure. Any non-following of any procedure, for example, directly issuing order without issuing of show cause notice or without giving any opportunity directly issuing any order will lead to non-following of prescribed procedure. And lastly, levy of tax without authority of law and abuse of process of law. So in these cases, the High Court can exercise its jurisdiction and provide remedy to the assessee. So one important takeaway in this judgment is that assessee needs to properly see when he wants to go with the proper way which is provided in the law, that is by replying to the show cause notices, by filing appeal, by attending the hearing, and when he has to skip all the process which is given in the law and directly apply for the court. So this is a double-edged sword which has to be exercised very cautiously, because if there is a presence of proper alternate remedy and if the circumstances are not which is given in this current judgment, then it may so happen that court may directly ask the assessee to file the proper appeal, to file the proper replies, and not to come with the high courts. And therefore, this judgment plays very important role. But interestingly, the High Court has held that the principles of natural justice have been violated in this case, since there was no mechanism, since there was no opportunity of being heard was given to the petitioner. Yes, sir.
Yeah, this is important. Sometimes, we know the principle that we cannot knock the door of High Court just like that if there is alternate remedy available. But if something is breaching the principle of natural justice or something is having a clear jurisdictional issue, then we can directly go to High Court without, going through the series of litigation. For example, this case of Gamescraft, where the notice was issued for 21,000 crores. In that particular case, the associate directly went to the High Court on the basis of principle of natural justice, even though there was an alternate remedy available. Now, there are certain issues where department passes abrupt orders without giving the proper reasonable opportunity of being heard. And if the orders, the litigation is going for years together, it can negatively impact the assessee. Two such cases are like one is the case of refunds. In case of refunds, if you are not producing the documents, it is seen that officers are abruptly passing the orders, which can sometimes have implication running in crores to the taxpayers. So in that case, assessee can directly go to the High Court saying that I was not given the proper reasonable opportunity of being heard, and the matter can be settled immediately. Generally, it is seen that in writ petitions, the legal remedy or the dispute settles much faster as compared to the regular this thing. Second is in the case of e-way bills. It is seen that, on a very, I would say, hurried basis, the order is passed within a span of 1 week without even giving an opportunity or a proper reasonable opportunity. Even in these cases, assessee at times deposits a big amount of tax, which is blocking their working capital. At times, puts a bank guarantee, which is also blocking the working capital. Assessee can directly approach High Court in these cases as well. So the thinking that we have that we cannot knock the door of High Court unless we exhaust the alternate remedies is not always correct. One has to look at the facts and circumstances and the situations underlying the case to determine whether to go to High Court or to go for appeal. Yeah, Venkatesh.
Yes, sir. So the next judgment is in relation to presence of cash in the electronic cash ledger and whether that cash will amount to payment of tax liability. So many a times we must have faced while filing GSTR 3B that if the GSTR 3B is getting delayed by 2 or 3 days, if we deposit the cash by 20th, whether there will be any interest liability even if I file the return after 3 days, 4 days, or do I have to actually file the GSTR 3B to avoid any interest liability is what is discussed in this particular case. So the Jharkhand High Court in this particular case has examined similar facts where the assessee had deposited certain cash in their cash ledger and the return was filed at a belated period. So the assessee contended that since there was the cash was always present in the electronic cash ledger, while calculating interest, cognizance has to be given that to the cash deposited. And on the other hand, department contended that without filing of GSTR 3B, the cash cannot get offset, and thereby there is no payment which is given to government. So in this case, the Honorable High Court has held that only when the cash ledger is debited, the amount as tax is getting deposited to the government. But when you deposit the money into cash ledger, the amount does not get transmitted to the government as tax account, but only after filing of 3B only government will get that particular cash. Second, the electronic cash ledger is an account of the taxpayer maintained by GST system, reflecting the cash deposits in the recognized bank. And it contains only the summary of the whatever money has been deposited. Third thing, when your assessee wants, he can apply for the refund in the cash ledger. Thereby, there is no finality that government has received that amount. And lastly, Section 39, which governs the gesture 3B, also stipulates that due date of making payment of tax is not later than the date on which the gesture 3B is required to be filed. That is, the due date is linked with the filing of gesture 3B only. So once the due date for gesture 3B is lapsed, the interest calculation will start. So merely by depositing the amount in electronic cash ledger, will not give away the cash element to the government is what has been justified in this entire judgment. Interestingly, there was exact opposite judgment which was rendered in case of Vishnu Arora Pouching Private Limited versus Union of India, whereby the court had held that merely non-debiting the cash ledger does not mean that government has not received the funds. That is, once the taxpayer pays the amount to the government treasury, it will get into the pocket of government, and by debiting the amount by way of filing of 3B is just merely allocation of funds within their internal pockets. So once I pay the amount, it goes to the government, and that date of depositing the money shall be reckoned for the purpose of calculation of interest liability. Now, this is a very important judgment because as the 3Bs are getting filed on monthly basis, we always have to take a call whether if there is a delay in the filing of GST 3B, then we cannot always take a call that presence of cash in the ledger is a safest option because it is also getting challenged under various high courts. So unless a judgment from Supreme Court or any clarification from the department comes, there is a split judgment of various high courts in this regard. Yes.
This has been one of the very sticky issue. Many assessees, especially during 17-18, due to various reasons, they could not file their 3B and they have deposited the money before 20th in their electronic cash ledger. Now, unfortunately, even if I want to pay the tax, the portal does not allow me to pay the tax until I file GSTR 3B, which is not a proper law as per the provisions. Now, with this restriction, now the court says that for that period you need to pay interest because tax was deposited but not paid. I feel this judgment is with due respect to the Honorable Jharkhand High Court. In my view, this judgment does not give the correct picture of the law. First and fundamental aspect is that if the money that assessee is being deposited to the by making a challan, if this money is not getting credited to the account of the department's treasury, then where is this money? Is it lying in the cloud? Certainly no. And you cannot say this is like a wallet or like a Paytm wallet, and assessee anytime that he wants, he can claim the refund. That is precisely the language of the judgment. This statement is not correct. Assessee cannot take the money back at its whims. Like a Paytm, you just swipe and the money comes back to your bank account. Sorry. To claim the money, you have to make a proper application of refund, give the complete explanation to the officer, undergo the complete scrutiny, and then claim it back as the refund in your bank account. And we know the hassle that has taken place to claim this money from the tax officers. Fundamentally, when we look at the rules, there is a proper challan that is being generated with a CIN number stating that the money being credited to the treasury of the government. Now, that being the case, how can this should not be treated as a tax payment is a question that needs to be looked at. Department in the court in this judgment also distinguishes the balance in electronic credit ledger with the balance in electronic cash ledger, wherein for the balance in electronic credit ledger, there is already an amendment in the law that interest is not applicable. So how can a balance in credit ledger, there is no interest, but a balance in cash ledger, there is an interest? And court gives a justification that for balance in credit ledger, the money has gone to the government, and for balance in cash ledger, it is just a deposit, money has not gone to the government. This is precisely not the factually correct argument. In both cases, money has gone and sat to the credit of government. In fact, it may be possible that in the credit ledger, the money has not gone to the government because supplier has not deposited or not timely deposited. But in cash ledger, 100% there is a proof that the money has gone to the department. So in my view, Vishnu Aroma judgment still is a correct position of the law, but we need to wait for maybe the larger bench of the High Court or the Supreme Court judgment to come in on this matter.
Yes, sir. So the next judgment is in relation to the refund of accumulated ITC in respect of services under inverted duty structure. So in the judgment of VKC Footsteps India Private Limited, we can see if you look at the facts of the case, we can see that the petitioner was engaged into supply of footwear, which attracted GST at the rate of 5%. So to provide this footwear, various inputs and input services was there, which was being used. Input services such as job work services, GTA services, and inputs such as leather and polysol, etc., were being used for manufacturing the footwears. These inputs and input services attracted GST rate of 12 or 18%, whereas the footwear attracted the rate of 5%. So thereby, the petitioner was eligible to claim refund under inverted duty structure because as per section 54 subsection 3 of CGST Act, where the rate of inputs is higher than the rate of tax payable on outward supply, the taxpayer is eligible to claim refund under inverted duty structure. And therefore, as they were not able to utilize the entire amount lying in their electronic credit ledger, they applied for refund. But while applying for refund, the petitioner also added the element of input services in that refund. And then they challenged the validity of Rule 89.5, which specifies that input tax rate in relation to inputs only should be added while calculating the net ITC, and input tax credit in relation to input services shall be excluded. So in this case, the Honorable Supreme Court has held that if we look at the wordings of Section 54, subsection 3, it is clear that inverted duty structure refund is allowed only when the credit has accumulated on account of rate of tax on inputs is higher than the rate of tax on output. Thereby, a clear-cut wordings is there that only when the rate of tax on input is there, then only they can apply for refund. But input does not contain input services. Therefore, the court has held that input has to be construed to include only input goods and not input services. And later, the Supreme Court has also held that refund is not a constitutional right, but refund is just a statutory right, and therefore it's not an unconditional right, which is granted by Constitution. And thirdly, Supreme Court had acknowledged one anomaly which was there in the formula for calculating the refund, which the formula was not taking into account the output tax on inverted supplies with the same ratio in which ITC on input and input services was there. So there was no apple to apple comparison while calculating the refund amount, and thereby the Supreme Court had suggested the CBIC to make some certain amendments in the formula, and accordingly CBIC by notification 14 by 2022 had made certain changes in the formula, which has increased the amount of refund to that extent of output supplies by applying the same ratio of ITC which is there on input and input services. Sir, anything you want to add on this?
Okay, yeah. So in this particular case, I would say now that Supreme Court has very clearly mentioned that GST input tax credit is not eligible for input services. One and fundamental aspect which manufacturers can look at is, can it be possible to convert the input services into inputs to claim the refund? For example, can a labor contract or a job work contract be rather considered as a purchase and sale transaction rather than a job work service? Can a manpower supply transaction be looked at conversion into employment contract? Of course, there would be a hassle. But then these are some structuring possibilities that the businesses would have to look at to see if the credit can be claimed on inputs rather than since it is anyway not eligible on input services. For example, in case of textile companies, there will be a lot of job work that would be there. So can this be rather made a transaction of purchase and sale? This is one aspect. Second aspect is now there was a aberration in the formula which has now been corrected. The question is, with the revised formula, there is no doubt there is an additional refund coming. Whether this revised formula has to be applied right from the beginning or it has to be applied now from the time it has been changed. It is very clear that when there is an anomaly in the law which has been corrected, then the correction has to be read retrospectively. This is a settled principle. So in our view, this revised formula has to be applied retrospectively. And a first assessee who has not claimed refund based on the revised formula for the past are actually eligible to claim that balance refund as well. So this is an important aspect to be looked at when it comes to inverted rate structure. Proceed, Venkatesh.
Yes. So next is an advanced ruling. Generally, advanced ruling does not is not applicable to other assessors. It's only applicable to the applicant who has sought that advanced ruling. But this advanced ruling reflect the intention of the government, the intention of the department. So therefore, it's very necessary to discuss this advanced ruling. Before venturing into advanced ruling, if we can discuss ISD versus cross charge, it will be relevant while interpreting the advanced ruling. So we have seen that in current business environment, there is a head office which is situated in a particular state, and its branches and other entities are scattered among various states. So for the purpose of GST, each the state, each such location operating in different states needs to take registration. And all those entities shall be deemed to be a distinct person. That is, there shall not be considered the same person, but shall be deemed to be a distinct person for the purpose of GST. So whatever common expenses are being incurred at the head office is generally shared between these branches. So from this thing, the concept of cross charge has emerged. Cross charge is a concept where GST registration of one office, GST registration of one office raises invoices on the other office, which is having a separate registration towards the services provided to such other office. So in cross charge, one office shall raise invoices on other GST registrations on the basis of the services or goods which have been supplied. As we have seen under GST, all the entities of a same pen are to be considered as a distinct person. Whatever goods or services are being supplied to some this distinct person has to be under the ambit of proper invoicing. So this is a cross charge concept which is used for internally sharing the cost of goods and services between the entities. And then there comes a concept of ISD. In ISD, the head office or the corporate office, which receives the input services that are exclusively either to some of the unit or to some various other units, has to be allocated in some proportion. In ISD, there is no service which is being rendered from group office to the its constituents, but it is the outside parties invoices which is being allocated to the branch offices in some prescribed manner. So third party invoices will be there in ISD versus in cross charge, there will be internal sharing of the uh, costs and services. So in ISD, only input services are being transferred, but in cross-check, either goods and services can also be transferred. So with this background, if you look at the advanced ruling obtained by Cummins India Limited, the Cummins India Limited had particularly had two questions. Where first thing, in common input supplies which is received by one of the units of the entity, if that particular common, if that ITC relating to that common inputs is being transferred to further, if it's further allocated to other entities, then whether they need to add some markup on that particular transfer or can they enjoy pass-through status was the first question. And second is whenever they're allocating some costs to the constituent entities, at that time, whether the salary cost which is being apportioned by head office to the branch offices, whether that salary cost will also have GST implication to be imposed. That was the precise question. So in this case, uh, the advanced authority bench has held that there is no need to add markup on the common services which is received by one branch while allocating the inputs while allocating the ITC on such inputs to other branches, because the branch which is allocating the ITC is acting as a pure agent, and therefore there is no need to add any markup, and there is no need to tackle the provisions of valuation in such cases, that transferring branch can enjoy the pass-through status. But at the same time, they need to take ISD registration in this case, and then only they can distribute the common ITC on input services, which is they can distribute the common input services on the to the other branches. And second question, which is being answered by the ruling authority, is that whenever the employee is working for head office, but while working in the head office, if the cost of those employees are being transferred, is being shifted to the other entities, then on such apportionment, GST will be charged. GST has to be applied on that salary portion as well, which is held by the advanced ruling authority. Now, if we see this ruling, it will open a Pandora box of the litigation, because under GST, it has been clearly stated that services by employee to the employer in the course of employment is outside the purview of GST. But this advance ruling is considering the employee in relation to that particular entity, and they're restricting it only in relation to that particular registration. That is, employee of a particular location cannot be employee of the entire entity, but it has to be get conservated only to the extent of that particular location, and thereby any services which is being provided by the employee to some other location is liable for getting taxed as per this advance ruling. And further, in that, inclusion of salary cost in valuation for cross check of services is very detrimental for exempted sector, like any healthcare sector or education sector. We can see that the outward supplies are exempt. So whenever any common services are being charged to the other entities, at that time, if we also add the salary cost while calculating the cross charge, then it will add to the hardships of the particular taxpayer, because the receiving side may not be able to get the full input tax credit at that time, and thereby making the GST as cost for the entire organization. Therefore, this advance ruling is highly subject to litigation. But yes, the major thing in the advance ruling is that it is applicable only in relation to that particular assessee and only in relation to that particular transaction. Therefore, this advance ruling may not be applied to the other taxpayers.
One thing very important is that now the Pandora box has now opened for ISD versus cross charge. The question is, if I've already done the cross charge, whether I need to still take registration as ISD. Now, what is now being interpreted is that ISD is different from cross charge. ISD is to load or to distribute the item of expenses which are relating to head office and not specific to any unit, where head office is billing to the various branches for the expenses which are pertaining to head office commonly. In that case, the ISD concept would come in and head office need to distribute these credits, or where let's say the expenditure is specifically for a particular unit, but the bill has come to head office. When there is no underlying supply from head office to the branches and only the bill has come to the head office, which is required to be transferred to the branches, the correct mechanism is only through ISD. And where there is an underlying service from head office to the branches, either by way of administration or any other support, the correct mechanism is cross charge by way of invoicing. Now the question that comes is, if anybody has not followed this system, what is going to happen for the past? In our view, if still an assessee has raised a cross charge and has done a cross charge at a appropriate valuation, there should not be any liability on account of revenue neutrality. But we need to understand that revenue neutrality can be questioned by the department on the basis of two grounds. One is that in case of ISD, even the ineligible credits also needs to be distributed, and the reversal is required to be made in that, the recipient's registration. Whereas in case of cross charge, the reversal straight away takes place here only, and only the eligible aspects, goes ahead. So that can lead to differential treatment, and even in the rule 42 reversal calculation, the entire matrix could change. Second, in case of cross charge, there is no restriction on valuation. As long as justified valuation is there, it is accepted. But in case of ISD, there is a specific formula given, and the distribution has to happen in that valuation only. So these are two differentiating factors. In our view, although this is entirely revenue neutral and a procedural requirement, but this can be, considering the judgments that are now coming, this can have a potential impact of litigation. So it's important to look at all the transactions between HO2 branches and to see whether a requirement of ISD can come in, and if yes, when an ISD distribution is required and when a cross-charge billing is required is something one has to look at. We can proceed, Venkatesh.
Yes, sir. The next judgment is in relation to corporate guarantees. This judgment is relating to service tax regime in which the taxpayer had received a corporate guarantee from their sister concern in foreign country, whereby the foreign entity had provided guarantee on the loan amount which has taken by the taxpayer. In this respect, the department has contended that whatever is provided by foreign entity is supply of service, and thereby the Indian entity is importing those services. Thereby, there is a liability to pay service tax on such services. Here, the taxpayer has contended that as per Section 65B of Finance Act, the definition of service would indicate that it relates only such service which is rendered for valuable consideration. So, presence of consideration is necessary in order to establish any activity as services. The Honorable Supreme Court has also observed that the taxpayer had not received any consideration by providing corporate guarantee to their group company in India. Further, the authority also could not demonstrate that how the issuing of corporate guarantee is a taxable service when it's done without any consideration. So, if we summarize this entire judgment, we can see that because of the absence of consideration, the court has service, and also there is no service tax liability. But if we apply this judgment to GST, we can see that under section 7 subsection 1 clause C, it says that the transactions which are there in schedule 1 are also considered to be supply. And in this particular schedule, the entry states that the transactions between the taxpayer and the associate enterprise, even without consideration, will also fall within the ambit of supply. So, therefore, we can see that the transaction between related parties to be taxable, even if there is no consideration element involved. Though we can always counter this entire arrangement of corporate guarantee that it is just money which is included and nothing else, or it is an actionable claim. But still, there is a huge implication on this ground because since the entire arrangement is considered as supply, department may definitely ask that even if there is no consideration involved, there is a provision of supply, and once there is supply, there can be a GST liability. But the problem is under GST law, there is no valuation mechanism which is provided for computing the actual value of the supply of guarantee given. So there is no valuation mechanism which is provided, and it has been held again and again by various high courts that if there is no valuation mechanism provided, then there cannot be any levy. So we have seen that various notices or letters have been issued where there is an involvement of corporate guarantee. But yes, without the valuation mechanism, we can always question the valuation, because valuation is one of the important factors on which the tax liability is to be determined and assessed. And in the absence of valuation, we can always challenge the levy.
So corporate guarantee is the new animal, I must say. Department is now first they'll look at the balance sheet and they're reading where is the corporate guarantee. If there is corporate guarantee, immediately the demands are being raised on the calculation of 1% of the valuation amount and of the guarantee amount, and for that, on that 1%, 18% is being levied. Fundamentally, a question that comes is whether at all there is a supply of service or a transaction between related parties in the corporate guarantee, or whether it is a tripartite transaction where actually the guarantee is being given to the bank by the the holding company, or by the other corporate, for assuring that the payments would be made. So whether at all it's a related party transaction is first fundamental question that comes, and the application of Schedule 1. Second very important question is that when we look at the definition of service, it says that uh, money is outside service, and use of money is covered within that ambit of service only when there is a separate consideration charge. So how can a use of money, corporate guarantee is nothing but a use of money. How can a use of money be levied to GST when there is no separate consideration being charged for the corporate guarantee? So whether at all it fits within the definition of service is an important question to be answered. Second very important aspect is that many times the guarantees are in the personal nature, where the directors give their personal guarantee, promoters give their personal guarantee. In that case, it cannot be said to be in the course or furtherance of business of the promoter, and hence it can be outside the ambit of GST. Next, very important aspect is that if assessee has already done a cross charge for the common expenses, then can it not be said to be already included in the valuation as a part of administrative support which the HO is given to the branches, and the valuation would not be questioned basis Rule 28. And the next very important aspect that needs to be looked at is when the guarantee is given in, let's say, financial year 2018-19, whether this implication would be applicable for each year based on the charges, or it would be only for that particular financial year, because department is saying if the guarantee is given in 18-19, then for each of the years this GST applicability would be coming at the rate of 1%, which is not justified. And of course, the last aspect which Venkatesh already told about, how can the valuation be there when there is no mechanism which is given in the law. So these are, I would say, arguments why GST should not be applicable on the corporate guarantee. Having said that, if assessee is eligible to take input tax credit, we generally don't suggest to go for litigative approach. And if the recipient is eligible to take credit, better to charge, collect, and pay off the GST liability rather than disputing the same. But for the past, certainly it is a wonderful case to be contested. Yes, Venkatesh.
Yes. So the next case is in relation to eligibility of ITC due to late furnishing of returns. So in this case, the registration of the taxpayer was cancelled because he was not able to furnish returns for a consecutive period of 6 months. Under GST law, if returns are not furnished for a consecutive period of time, then the registration of the particular taxpayer will get cancelled. After that, the taxpayer also could not file for the revocation of such cancellation of registration, and the cancellation order is an appealable order, but the taxpayer also failed to file the appeal before the appellate authority within time. Therefore, the taxpayer was not having any other option other than to file the writ petition before the High Court to revoke their cancellation. Similarly, when this case was there, the government had issued a notification 3/2023, which has allowed the taxpayers to restore their registration, whose registrations have been cancelled before 31st December 2022 by filing the returns. So one amnesty scheme has been introduced by government by way of that taxpayers can file their returns before 30th June if the registrations have been cancelled before 31st December 2022. So now the taxpayer can file the returns and everything can go smoothly. But one aspect which is to be looked here is if the taxpayer has not furnished the returns, say for financial year 21-22, then and if he is going to file those returns right now, then the major problem which will arise that in those returns, he will be claiming the input tax credit. But for the financial year 21-22, the time limit to take input tax credit is only up to the due date of September GSTR 3B of the next financial year. That is, the 3B of September 2022 is the due date before which the taxpayer was supposed to take the entire ITC. So now, even if today the taxpayer files the return, the department will again issue a notice questioning the ITC claim, stating that the ITC was supposed to be taken on or before September 2022, but since the ITC is taken somewhere in 2023, the ITC is denied to the taxpayer. So in this case, the High Court allowed the taxpayer to claim the ITC in respect of that cancellation till the registration is restored. So the High Court has held that taxpayer can claim the ITC for that particular period from the date of cancellation till the date of actual restoration of the registration. So one biggest takeaway in this particular case law is that if the registration is cancelled and if it's then rightfully restored, then whatever ITC is there for that period can be claimed. This is point number one. Point number two, that though the judgment is in relation to RC cancellation, but the analogy of this judgment can be applied to those cases also in which the registration may not get cancelled, but the taxpayer might have furnished returns which has surpassed the due date which is given in section 16(4). That is, even if the taxpayer files it done after September and the ITC claimed in that particular returns can be claimed through the help of this particular judgment. So, in my opinion, these are the two major takeaways in this judgment. Sir, anything you want to add?
Nothing. Only thing is that this judgment can have a very wide approach where it can be said that any cases where ITC could not be taken by assessee because of it was not possible for him to take, this judgment can be applied.
Correct. So, the next judgment is in relation to the incorrect GSTN furnished while filing GSTR1. So in this case, the petitioner had filed GSTR1 by mentioning wrong GSTN of their customers. Thereby, the customer was not able to take the input tax credit because the GSTN was not pertaining to him, and thereby it was not getting reflected in their GSTR2A. And the time limit to make amendments in that particular GSTR1 was also lapsed. So there was no other option which was available to the petitioner, and thereby he filed a writ petition. The court had allowed the correction and also said that the portal shall make some arrangements so that GSTN can so that taxpayer can make the amendments. So the GSTN has to be open for some limited time, and this shall be communicated to the petitioner, and then the petitioner should be able to rectify their returns. This was what is held in the particular case. So if we see that what is the major takeaway in this case is that in the initial phase of GST, there are many mistakes which have been committed while filing the GSTR1 and GST returns. So if this facility is open to all the taxpayers for a limited period of time, then majority of the disputes pertaining to 1719 and 1819 can be resolved, and there will not be any need to again go back to High Court for various cases, because this kind of cases are there are plenty of the cases which is in relation to in the same line and length of this judgment, in which the court have always asked the department to open the portal so that the taxpayer can make necessary amendments.
Nothing specific, Venkatesh. You can proceed.
Yeah. So the next judgment, the next is an advance ruling, which is in relation to GST on
No,
recoveries.
one minute, Venkatesh. Only one aspect which I would like to tell about the past judgment is that sometimes what happens is the place of supply is wrongly mentioned in GSTR1, or something is there where customer is not able to take credit, or in the GSTR1 you have wrongly put CGST, SGST or IGST. Sometimes if the value or the stakes are very high and the customer has held the payments running in lakhs or crores, in that case, one fastest relief that an assessee can get, even after if the time limit is elapsed, is that directly approaching the High Court, and High Court can grant an immediate, interim relief and a final relief. So this was also in one of our clients where we have filed writ petition before Bombay High Court. We got the relief, and now that particular thing is being enabled so that the credit can be claimed. So this will be a specific case where GSTN will enable this mechanism only for you. based on the direction of High Court. So this is something I would say one tool which we have that can be used.
So the next is an advanced ruling in relation to recoveries made from employees. So the GST element in relation to the recoveries have been examined in this particular advanced ruling. So many times the entity provides various services to their employees like canteen facility, transport facilities. In these cases, the canteen and transport facility have been provided by third party vendors for which payment has been made by the taxpayer only, by the entity only, but a certain nominal amount is being recovered from those employees. In these cases, whether whatever nominal amount which is recovered from the employees, whether there is any GST liability in relation to those recoveries made was the question of this particular advance ruling. So the question is also arising because employer and employee are related persons, and whatever amount which is recovered is for the purpose of canteen and transport recoveries. So thereby, in some cases, department had asked that whatever is you have recovered is a supply because you are providing the supply of canteen and transport, and thereby GST shall be GST liability will be there on these services. So in this case, the advanced ruling authority has held that once any particular benefit is there, which is provided in the employment agreement, then that entire benefit is governed by the employment agreement only, and whatever is there in the course of employment between employer and employee is outside the purview of GST. So thereby, once something is outside the purview of GST, there shall not be any GST liability on the same. After this advanced ruling, a similar circular was also issued, circular number 172, in which it has been stated that any perquisites which is being given by employer to the employee in the course of employment is to be considered in the course of employment only, and thereby it will be covered under Schedule 3. Thereby, that particular scheme or transaction will can neither be supply of goods, neither be supply of services. So thereby any canteen or transport facilities or any facility which is being provided by employer to employee, if that particular perquisite is there mentioned in their employment contract or agreements, then we can always take a benefit or claim that this, as this is already there in the employment contract, there is a as this is already included in the employment contract, this is in the course of employment only, and there shall not be any GST liability on the same. So with this advance ruling, I would like to add upon one thing that the employment agreements with the employees are to be verified or checked very carefully so that whatever services are being provided has to be in the course of employment. Thereby, if you provide any other service which is not there in the course of employment, may face GST implication.
Few important things is that this ruling is only for employee recoveries. Hence, if there is a certain recovery in the course of termination of the employment agreement, for example, car lease policy, mobile, policy, where the asset is being then taken over by the employee. This may not be covered under this transaction because it is not in the course or furtherance of employment. Rather, it is post the termination of employment. One. Second aspect is that this ruling would not be applicable for vendor recoveries because vendor recoveries, when the amount is not being paid, the proportionate input tax credit has to be reversed or it has to be paid by way of levying GST on the same. So there cannot be an unjust benefit on account of vendor recoveries. Third important aspect is that on vendor recoveries, the tax can be paid only on the actuals instead of open market value. And I would say one another important aspect to be looked at is now when we are not paying GST on recoveries, there is no restriction of ITC. And hence one can look at claiming ITC in full on canteen services. These are few important implications. We can proceed to the next one, Venkatesh.
So next are some judgments in relation to input tax credit. I have summarized the entire judgments.
We can
Some
only
important
give the crux of
yes,
these judgments.
yes. So the first is that whenever there is any cancellation of registration of the supplier, where whatever the invoices, whatever the procurements have been made from that particular supplier, the ITC in relation to those procurements cannot be denied. if it is found that the whatever procurements have been made are backed by valid invoices, documents, and also the fact that the registration is being cancelled was not known to the party, and also it is the procurements have been made before the cancellation of the registration. So this is the first. Second, there is a section 17, subsection 5, which restricts the input tax credit in relation to ITC, in relation to the procurements which is lost or destroyed or damaged, etc. So in this situation, if there is any invisible loss to the inputs during the manufacturing, so in any manufacturing there is a normal loss which is there, which is unavoidable. Then in those situations, the input tax credit in relation to that normal loss cannot be denied, because every manufacturing process would result into some kind of loss on account of evaporation or any creation of byproducts. Therefore, this is not a loss which is to be taken into account as per section 17.5, and the input tax credit shall be granted. Then the next two cases are in relation to Rule 86A. As per this rule, the electronic credit ledger of any particular taxpayer can be blocked for a particular period of 1 year if the operations are not found to be genuine. So in these cases, one aspect is that the blocking of input tax credit ledger cannot be done for more than 1 year. So after 1 year, the department has to release the electronic credit ledger, has to take up the bar of that particular electronic credit ledger. Next is that there is a important judgment of Safari Retreats Private Limited, which is pending before the Honorable Supreme Court. In this, the ITC in relation to construction expenses of commercial complex, which is not meant for own use or sale, but it is meant for rental purpose, was allowed by the Honorable Orissa High Court, and this judgment is pending before Honorable Supreme Court, and therefore the implications on construction or lease of commercial complex, long-term lease construction contracts shall be verified only after the deliberation of Supreme Court's judgment in this particular issue. Then next are some important judgments which are in relation to show cause notices. Now, because of the introduction of GST, the amount of show cause notices have increased, and there are many cases in which the proper mechanism through which the show cause notice to be issued has not been followed. In the first instance, we can see that if the show cause notice or the assessment order does not give any reasonable time for a taxpayer to respond back, then such show cause notice shall not be valid in the eyes of law, and such show cause notice has to be struck down. This is what is given in the first judgment, Manikan Ravichandran. The second judgment is that if the show cause notice is issued, in which the irrelevant portion has not been deleted, and some data of some other assessee is being mentioned in that show cause notice, then this show cause notice shall not stand good in the eyes of law, and such show cause notice has to be struck down. Later on, if the next judgment is in relation to Hindustan Police Corporation, which states that if there is some settled principle, which is some settled judgments are there, then those judgments have to be considered before issuance of show cause notice, because some settled principles are there. If we do not take into account those principles, then it will amount to duplication in litigation. Therefore, the crystallized law, the law which has been, there is no dispute against some law, then that has to be reflected in the show cause notice also. Department cannot go again back and demand the same thing. Then next judgment is in relation to 26 AS, which says that 26 AS is not a proper document to assess the tax liability for the purpose of indirect taxes. And last judgment is in relation to time limit to file the appeal. The time limit to file the appeal is a statutory time limit, and if the time limit is missed, then even the High Court cannot entertain that kind of writ petition. And lastly, there are some important judgments which are in relation to e-way bill, in which it has been stated the first judgment is in relation to vehicle movement, which was happening from principal place of business of an assessee to its additional place of business. But the problem was the additional place of business was not registered in the registration of the taxpayer, and thereby the vehicle, when it was intercepted, the goods were detained. So the High Court has held in this case that since both the recipient and supplier both are same person, there is no change in the persons, then there is no intention to evade taxes because there is no third party involved. From one leg of the entity, the goods are being transported to the other leg of the entity. So thereby there is no question of any third party involvement. And since there is no other person, then there is no question of tax evasion, and therefore such vehicle cannot be seized and penalty cannot be imposed. Secondly, just because e-way bill is being expired, it does not mean that there is a tax evasion. Sometimes the e-way bill will get expired just before the delivery of the goods because of some transportation issue and all those things. So, in case of any e-way bill expiry, the presence of tax evasion shall not be directly presumed. And last thing, last judgment in which is rendered in Greenlight's Power Solutions versus Union of India is that in e-way bill and in the invoices, there was some discrepancy in relation to date format. That is, in invoice, the DDMMYY format was incorporated, but in e-way bill, that reverse, that is month, day, and year format was incorporated. And because of that, there was some discrepancies which was there in the different dates on the both documents. So department has contended that this discrepancy is not there in the circular which is provided by the law, which states that for some minor breaches there shall not be any penalty and liability. So the court has held that for the circular was issued for any kind of mistake, typographical error, or which are minor discrepancies. And change in date formats is a minor discrepancy which does not alter the tax liability, which does not alter the valuation of the goods. So thereby there shall not be any penalty provision on the such minor discrepancies. Yes,
Okay, so I think with this, all the relevant judgments are covered, Venkatesh.
right, sir. It's all good.
Okay, so I think there is one query coming on ISD versus cross charge. So the point which I'm trying to make is that ISD is a mechanism of distribution of credit and cross charge is a mechanism of levy and charge of GST. Distribution is in a scenario where there is no supply, yet the bill has come to HO, where the appropriate mechanism is to be followed is distribution. Charging is a system where there is a supply, which is underlying supply, and the mechanism is charging by raising a tax invoice. So this is the differentiation which is there, and it is also not revenue neutral fully, which I have already explained in the earlier discussion. Uh, so with this, I think this feedback form has been shared in the chat box. It would be great if you can fill that feedback form so that we come to know about the feedback of the session and also to look at what are the future sessions to be rendered. Uh, in case you have any queries, you can please put in the chat box. We'll try to extend for a couple of minutes more and answer the queries. And if your query is not answered or not answered properly as per your expectation, we suggest you can write an email to us so that we can reply to that email with the query, with the answer. There's a question which is there. It says, if an employee employed by the HO is giving service to branch, is it cross charge? Answer is no, because as already explained by Venkatesh, that cross charge cannot be applicable on the services by employee, because eventually the employee is not the employee of HO. He is an employee of that particular entity. And on that transaction, there cannot be an implication of GST. Although department is started taking a contrary view, but I would say there are enough safeguards in the law to support the view of the taxpayer. Next is also, if an employee's sister concern is rendering service to another system, is it liable to GST and cross charge? Yes, because we need to the definition of related party is very wide in GST. However, I would say you should look at the percentage shareholding, how it is there, and how the sister concerns are actually the structured basis that you need to see whether it falls within the ambit of related party. It's very difficult to answer the question based on the word sister concern. We need to look at the actual shareholding that each of the concerns have with the other entity to conclude and give an answer on this question. So thank you all for patient listening. With this, we conclude our today's session. We are planning another session on the topic how to handle departmental audit. Rather, we are planning a workshop rather than a session because it is seen that a lot of departmental audits are being taken place nowadays, and assessees needs to be conservant of the fact as to how do they approach the departmental audit, how do they reply to that big checklist that has come. So we will be taking one practical workshop on this particular topic. We are yet to decide whether to do it as a physical session or a virtual one, but do share your feedback so that we can accordingly proceed. So thank you all for patient listening.